Hi, I'm Simeon Wallis, Chief Investment Officer of Aprio Wealth Management, and welcome back to The Pulse, where we take a month-to-month look at what happened in the economy and the capital markets so you make better decisions in your business and with your investments. Let's start with the highlights. After October's rally, investors have taken some profits in both stocks and bonds. That's despite strong corporate earnings. Now, we're in earnings season, and positive comments have been driven by AI innovation and generally solid fundamentals. With the government shutdown and headline layoffs, consumer sentiment has dropped sharply, yet spending continues. And finally, inflation's cumulative impact since 2020, nearly 30%, is still weighing heavily on household budgets and impacting recent elections. Now, let's take a deeper look at the data, see what else we can learn. November has started with global markets generally with a risk-off sentiment as the NASDAQ and emerging markets are leading the decline. It's a similar story with bonds, commodities, and crypto, which is down 5% for the month. Now, the quarter has been more mixed, with most markets higher, leading to strong year-to-date returns for large U.S. companies as well as international markets. Bonds are still up about 7% on the year on the back of modest growth and Fed rate cuts. Over 80% of companies reporting third quarter earnings are reporting higher than expected earnings, and more than 65% of them are reporting higher than expected sales. These positive reports are one of the widest gaps in outperformance over the last decade. Despite all the headlines, markets have been surprisingly muted. Returns this earnings season are modest compared to history, signaling that investors may be more focused on pocketing their gains for the year. Earnings growth is picking up again across small, mid-sized, and large companies, excluding the Mag 7. After a slowdown, we're back toward trend growth, which is critical for stock valuations. Yet since ChatGPT launched in late 2022, AI-related companies, which are here in purple, and the Magnificent Seven, which is in black, have seen earnings surge, far outpacing the broader market that we just saw. The steepness of earnings expectations for AI-related companies and the Mag 7 is likely to support this market. On the consumer side, retail sales remain resilient. Even with inflation pressures, spending has held steady, showing that households are still supporting economic activity. Spending growth is being driven by the top 10% of earners. Their share of total spending has steadily climbed, making affluent households the key engine for consumption. Not surprisingly, over the last 3 decades, this generally follows the wealth accumulation of baby boomers. As we've noted in prior episodes, lower income consumers are stressed. Despite the still growing economy, consumer sentiment with the lowest income consumers, which we have here in red, is at the lowest level since the early 1980s. We're seeing a clear pullback in discretionary treats like fast casual dining. Traffic at places like Cava and Sweetgreen has slowed compared to more consistent performance for quick service restaurants such as McDonald's, Chick-fil-A, and Taco Bell. For the quarter, the stock prices of Cava and Sweetgreen are down 20 to 30%. Now, one reason for the weaker sales at higher price point quick service restaurants, the resumption of student loan repayments. Student loan delinquencies are spiking, adding financial stress. While mortgage and credit card trends remain stable, this spike is a warning sign for many balance sheets. And we're seeing consumers pull back on discretionary items, particularly travel, on home furnishings, clothing, and in drugstores. Inflation is ticking up in real time, though still below its peak earlier this year. This upward trend adds pressure on budgets, and it could influence spending decisions. And since 2020, prices are nearly 30% higher. That cumulative inflation is a major strain on consumer wallets and is part of the frustrations that many feel. To sum up everything from today, here are the key takeaways. Markets cooled after October's gains. Earnings stay strong, powered by AI. Consumers feel uneasy, yet they keep spending. And inflation's long shadow, 30% higher prices, continues to squeeze wallets. With that, I'm Simeon Wallis, Chief Investment Officer of Aprio Wealth Management, and I'll see you next time with our next edition of The Pulse.